What's up, everybody? Throughout these past few years or even decades, the strategy known as SMC or ICT has been gaining lots of popularity. Today, we'll be going over if that truly is the right decision or if there are better options to look at and develop on as a trader yourself. So, I want to start it off by explaining to you guys what our strategy here at V2 Trading is. Our strategy is called V2, right? And what V2 is a combination of simple price action, order flow, supply and demand, or support and resistance. They're essentially the same, as well as a little bit of dilly-dallying within smart money concepts as well, and also volume analysis. All of this in unison makes up what we call as the V2 strategy. But what ICT is, or SMC, what this is in my opinion, this is just vocabularized price action. It's just price action with silly and vocab style words. So for those people that are good at memorizing vocabulary and like that type of stuff, then SMC may be for you, but it essentially is vocabularized price action. It's the same thing as price action. It's simply just with some vocab words on top of it. And with the addition of support and resistance, which is essentially just liquidity levels. It's all essentially the same thing from multitude of strategies, all within a multitude of names. Like you have supply and demand, you have SMC, you have support and resistance, you have liquidity, chart liquidity, not institutional like order flow, and then you just have price action. Price action is what makes all of these things work. Without price action, none of this would occur. And I want to show you how exactly SMC, smart money concepts, is just vocabularized price action. So let's take a look at this trade right here, right? And assuming we did use smart money concepts, right, with the fair value gap and the liquidity sweep down below, I did use this. I did use those SMC concepts in order to make this trade. But you can see those occur in so many different locations that it's insane. And there's no real confluence. Look how strong we're pushing down into this fair value gap, but still we reverse with heavy strength. Now, this is a fair value gap right here, right? We saw price retrace into it. We saw our red candle essentially close outside of the fair value gap. And then we pushed back up. Now, most ICT traders may feel like this fair value gap broke and it's an inverse fair value gap play, taking price down further. And as you can see, price action does agree with that as well. But what we don't understand is that liquidity had gotten swept and we started seeing increase in buying pressure. Now, at V2, what we do is we essentially look and focus off of retracements, right? And when we do see retracements occur and strong reactions, we enter. But just like anything, do you really think that actual professional traders that have been in this game for many, many years are simply marking out lines on their chart and expecting to make profitable trades with it? You think I can just mark a box here, call that a zone, mark a box here, call that a zone, mark a box here, call that a zone? Oh my god, when price touches this zone, it's gonna reverse. Nobody really knows none of that at all. But what we do know at V2 trading is that price moves by orders and by price action. And you have to understand that the market is an auction. You have to know what bid and ask is to truly understand and make sure your analysis is different from gambling. This is what I want to emphasize. Just by marking out lines or fair value gaps or all of these setups on the charts, you can make profitability. But what you're essentially doing by doing so is you're essentially gambling with having, you're essentially gambling. Like, that's all I can say. You're likely gambling with a 50% win rate or lose rate, and the market can shift on you anytime because the market is not reliant on any of these lines. It is reliant on the orders that are within the market. It is not reliant on any of these lines at all. Now, at V2 and the V2 strategy, the reason we mark these lines are they provide us some sort of insight as to where potential orders may be placed. Realistically, you could trade without these lines at all. But simple auction mechanics tells us that if price went down, made a big candle up, and if price looks like it wants to go higher, price may make a short retracement and continue towards the upside. That's simple auction mechanics. And if you think about it in terms of auction, sellers may want to push price down a bit more and buyers will get nice entries at that location. And when buyers push the price up, many of the sellers get stopped out, which boosts the buy orders even more, providing even more aggressive buyers into the market. That's why retracements are very powerful, and that's why retracements are one of our main tools here at V2. And we do use smart money concepts. We do use fair value gaps, and the reason we do so is because what are fair value gaps? Fair value gaps are essentially just areas of retracement that we can head towards. It provides us an area of potential interest for us to seek validity from. Most fair value gaps do fail, but in the right context and with the right auction mechanics and understanding, they can work pretty nicely. Now, what ICT is with all the fair value gaps, order blocks, and all of that, it's essentially just price action. Price action is seeing the movement of the candles, understanding the action of the price, a simple market structure. That's all ties in with price action. And what a fair value gap is, it's simply just another word for area of retracement where price can go up. Many price action traders have been using fair value gaps indirectly and have been succeeding for a long, long time because they keep it under the right context and use price action analysis to do so. But what is happening in the current day is that many new ICT or SMC traders, they're getting straight onto the markets. And what do they look for? They look for any random fair value gap or any random area where they can just find an entry in. And although there is a gap, what is the significance of the gap? We don't have to go fill it. We don't have to even return to that area. Simply, if we just go to the past anytime, look over here. There's such a huge fair value gap here according to SMC or ICT traders, right? There's such a big fair value gap, and there is one here as well. And this one would have actually worked out. Bad example, but I'm trying to find the area. Okay, perfect. Look at here. Look what happened to the price. The fair value gap essentially just got ignored and broken through. But what happened? We still continued to see upside. You could have even likely considered longing down at these lows by using simple price action analysis. And with SMC, by marking these boxes, there is no guarantee that you're going to succeed. Many people fail because they make this mistake of making boxes and essentially just following what is supposed to happen without considering what may not happen, which provides them at a disadvantage in terms of the market, and market makers are starting to get a hang on all of these new traders, and as they're seeking liquidity, many of these normal retail traders are failing. The fair value gaps literally is just oversimplified, over vocabularized, not simplified price action. Breaker blocks are essentially the same. They're just market structure oversimplified. Order blocks over vocabularized, supply and demand zones. Liquidity over vocabularized, support and resistance. Now liquidity is the only thing from SMC. Liquidity and fair value gaps are the only thing from smart money concepts which I will take and will say that those are decent. And why are those decent? Because these areas are areas of high intuition that has been proven within the market multiple of times, and there is significance within these levels. Now, for value gaps, the only reason is because it provides an easier level of area to look out for in terms of a retracement. But even then, for that, you can simply use normal Fibonacci to do so as well, or even identify when is a good area of retracement by using one of the most powerful tools in trade, order flow. You can use bookmap, and you can also use footprint charts in order for you to identify where price may make a reversal. This is everything inside of the candle which you cannot see. It provides you so much information that many other traders do not have, and with this you can understand where the auction is getting held and where the price may want to go next, simply through price action or volume analysis based on this. There's many ways you can analyze this as well. You can see where is the most volume being traded in every single candle, because the volume can be traded on the candle, but where exactly in the candle is a volume executed? As you can see, after this, in this large green candle, we actually saw volume at the top, which is very, very interesting and something to keep in mind. Now, there's many ways to use footprint charts to your advantage. There's many customizabilities, and there's many this and many that. You need to be able to understand why this is the reason that the market moves and not because of fair value gaps, order blocks, or any of that. I do believe many ICTA traders can succeed, and I'm not saying that it's not a good strategy. ICT traders, ICT and SMC in general is a decent strategy because it provides you some insight into simple price action and vocabulary. And if you have applied it enough and applied your own twist to it and applied where you have seen price action and actual confirmation within your trades, SMC concepts can be great. Don't take that away. But if you're a beginner, and getting into SMC can be quite difficult because you need to be able to understand. And I'm not gonna lie, getting into stuff like footprint charts and bookmap are even more difficult. But these are the actual reason why the market moves. The market moves because of the bid and the ask. When market orders hit the ask aggressively, we can move price upwards. If market orders hit the bid aggressively, we can move downwards. And you need a buyer for every seller, and you need a seller for every buyer. Market moves based on aggressiveness, not on if there's more buyers or sellers. It's all about aggressiveness. Now, coming back onto the charts, ICT is a good strategy. I'm not going to take it away that it's a bad strategy. The thumbnail was quite clickbait. But like any pure trading view strategies, it simply just lines on a chart. And without analysis of each and every candlestick and of price action and market structure in general, these order blocks, breaker blocks, fair value gaps, majority of them are going to fail. But if you can apply price action, market structure, and things that are essential for market success, even smart money concepts and ICT can be successful. Now, here at V2, we essentially combine everything within our strategy to a decent extent while not over exerting a single strategy. Now, we use supply and demand zones because they provide us some confluence and targets as to where price can go, and we use liquidity as well. By doing so, we get a decent grasp on where the market may have certain pivot points, and liquidity may provide us some good targets, especially if it lines up with where bookmap liquidity is being placed as well. With bookmap, you can see the passive orders, and it gives you what footprint could be missing, and the footprint gives you live execution, live orders, and shows you what the bookmap is missing. That's why I believe that if you can combine bookmap and footprint together, that it can be one of the greatest tools for any trader. Now, that's essentially all I have here for today, right? Let's just do a quick summary on what we have discussed. You have discussed that ICT is just complicated price action. And we talked about beginners lose. We talked about that many beginners lose. But we talked about how it can be great with application of can be great with the application of structure and price action and volume analysis. Understanding that simple breaker blocks and all these lines, it will make you fail. Charting equals fail. And when I mean charting, I mean marking these lines because you need to understand what is going on behind the market in order to succeed. Now, with the V2 strategy, what the V2 strategy is that we use supply and demand zones, we use liquidity, we use a decent amount of SMC without all the breaker blocks and shiny stuff, right? And we use it to make price action a bit more specific. And that's one good thing with SMC. It does make certain price action more specific. But you have to be careful when you specify or make your retracements more specific. That's why you need to add order flow. And after order flow, you understand structure, market structure. Then you understand where volume is located. Then you use your targets as supply and demand or liquidity. So now on top of SMC, we have all of this in unison to make it succeed. And to succeed, I truly believe that you need to have an edge in the market, and by simply marking out lines on a chart without proper analysis of the overall market sentiment, whether that be through market structure, order flow, or a combination, it will be very difficult to succeed and get a gauge on the market long term. So highly encourage each and every one of you guys to learn price action, learn market structure, and even potentially take on additional edges like bookmap and footprint charts. That's all I have here for you today. If you guys want to learn more about the V2 strategy for you to take great trades like this, please check out the video that will be linked in the description, because that essentially shows you a completely free application of bookmap and footprint, and it's a 34-minute video with pure value inside of that video. We take you through how this trade could have been made and giving you almost a 7 risk to reward ratio, which is very excellent. Additionally, we do have a 10 episode crash course here at V2 Trading that takes you through the ins and outs of trading and a little bit of the V2 strategy as well. And on top of everything at the V2 strategy, we do not force anything onto our consumers. We actually encourage that people don't use our strategy specified just how it is, because I believe that each and every trader has to have their own twist and has to make a strategy personalized to them for them to succeed. And to do so, you have to find your personal edge. Without having a specific and identified edge, it can be very difficult to stand out and actually succeed. That's why I highly encourage you to check out the videos on the channel, especially that free footprint and bookmap video, as well as a crash course. I also highly recommend you guys to join the Discord. The link is in the description down below, and we have a lot of free utility inside of the server as well. The Discord is completely free. Nothing is there that we are selling. I highly recommend you to join and learn a lot from the Discord as well. That's essentially all I have here for today. If you have any questions, please leave a comment down below or join the Discord like I keep mentioning. That's pretty much it. That's all I have here for today. And I'll see you guys later today for a pre-week analysis session, which we conduct every Sundays, and every trading day we conduct a market analysis or trade recap video as well. And I'll see you guys then. Goodbye.